Hey, how's it going? Welcome to Option Snipers University. This is your professor, Professor Wasi, and what we're going to go over today is all of the simple basics of options trading. All right. Now, without further ado, let's go ahead and get into the Sniper's Field Guide. All right. So one of the first questions we usually get is why options? Okay. Now, there's three reasons as to why we options trade here at Option Snipers University. Number one, we leverage capital. Okay. Number two, we control our capital. And number three, we use those profits to invest. Okay. The reason as to why we leverage capital is we have the understanding that we need capital to make capital. Okay. And what usually people say to that is that it takes money to make money. All right, guys. Now, when we have that money, we can then control it in the way in which we can decide to say, okay, I know what I'm going to be doing with this money based on whatever skill sets you potentially have. And now with this skill set we have options trading. So we're going to be controlling this capital in order for us to make decisions about it. And then eventually, which is number three, use the profits to invest. Now, what I use options trading to do is I have what I call a wheel of wealth. Okay. And what a wheel of wealth is to me is literally taking my options trading profits and putting them into other ventures. Okay. That could be business ventures. That could be investment ventures. That can be, charitable donations, whatever the case may be. Anything that can allow me to get to the next level of where I'm going in my life. Okay. And obviously it takes money to be able to do certain things. Okay. So this is why we trade options. All right. We're going to go over the table of contents. The first section is going to be the basics. Second section is going to be the candles. And then we're going to go over patterns. All right. Let's go ahead and jump right into it. Now, one of the first things we want to make sure we do is we have to have an understanding of just the stock market in general. Okay. When we're talking about trading options, we're talking about trading stock options. Okay. Stock options in general. They have other types of options out there, but we trade stock options. Okay. Now, what we want to do is we want to learn the key terms. One of the first terms we want to know is shares. Okay. And what shares are, they are units of ownership interest within a corporation. Okay. So if you have interest in a corporation, what you would do is you would put your capital down. And when you put your capital down, you then own a piece of that company. And that piece would essentially be called a share of that company. Okay, guys? And then we want to go over tickers. Tickers are usually either 3 letters or 4 letters that you would put into some sort of search engine or whatever to be able to do whatever research you want to do on a specific ticker. Okay, it's literally an abbreviation of what the company or organization is. Okay, so for Apple, we have AAPL. All right, Facebook now in past the year 2022 would be Meta. Okay, META. Amazon would be AMZN. Okay, Netflix, NFLX. So if you see these abbreviations of these larger company names, that is what a ticker would be. Okay, a dividend is a sum of money paid regularly by a company to its shareholders out of its profits. So if you are a shareholder in a specific company, you are then given some sort of dividend based on whatever the dividend per share is. Okay, so essentially, once you invest in the stock market and invest in a specific company, and it's time for their quarterly dividends to be paid out, you would essentially be paid for being a shareholder. Okay, that's what dividends are. Okay, now an ETF is a type of fund. It owns stocks of other companies and divides ownership of itself into shares. Okay, so an ETF would be essentially a compilation of specific companies that would form the ETF. Okay, one ETF that we trade here is SPY. Okay, we also trade QQQ as well. All right. Next thing is IPO. What an IPO stands for is an initial public offering, which is what is referred to as the process of offering shares of a private corporation to the public in a new stock issuance. Okay, so when a new company becomes public, what they do is they form an IPO. Okay, so let's say that there's a new public, a new company out there that's looking to go from private to public. What they then do is look to source money from investors so that they can have more money for their company. Okay, for their company valuation. All right. And then the next thing we have is a broker. Okay, a broker is an entity who executes transactions such as the purchase or sale of stocks to market participants, okay, in return for a commission. So a brokerage that we use TD Ameritrade. So TD Ameritrade is essentially the person or the entity that is given the right to either purchase or sell stocks on my behalf or another person's behalf. Okay. Like I said, the recommended choice of brokerage through Option Snipers University would be Thinkorswim. Okay. Portfolio. What is a portfolio? Portfolio refers to the compilation of individual stocks or options contracts that you own. Okay, so think of it, if you have a real estate portfolio. What's a real estate portfolio? That is a compilation of different properties that you have under your ownership. Okay, so think of that is the same way within the stock market. Okay, if you own different shares of Tesla, Netflix, Google, and then you have some options contracts that you own. That's your portfolio. Okay, those are your assets. Okay, then the exchange is a market in which securities are bought and sold from. Okay, so one of the exchanges that we trade with is the S&P 500. Okay, the Standard and Poor's 500. All right. Now here at the top of this, we have long bullish and short bearish. Okay, what a long is taking a position with the intent that the stock will go up in value. Okay, so if you want to go long, think about going long term in a relationship. Okay, that means you're in for the long haul. That means you are expecting that it should go up. Okay, that it should increase in value. Okay, now that would be what we call bullish. Okay, then short or bearish would be taking a position with the intent that the stock will go down in value. So it's literally the inverse of what long is. Okay, so if you want to go short on a position, what you're saying is you are anticipating that the individual stock or ETF or options contract, whatever the case may be, would be decreasing in value. Okay, that's what short or bearish is. All right, now let's go to the next screen. We have three types of snipers here at Option Snipers University. Okay, we have the aggressive investor, which is more high risk. We have the modern or moderate investor, rather, which is more medium to high risk. And then we have conservative investor, which is more lower risk. Okay, usually with high risk or being high risk, obviously there's high risk, high reward. Low risk, typically low reward. Okay. Now, when you're a high risk or an aggressive investor, most of the time you're looking at shorter term contracts with shorter term expiration. Okay. Sometimes you're actually buying and selling contracts literally within the same day. Okay. Now, with the moderate investor, they are more of a swing trader. And what a swing trader would do is they would hold a contract for a little bit longer than just a day, maybe even sometimes longer than a week. Okay, that's what it means to be a swing trader. Okay, and then someone who's more conservative, they're more so a position trader. So they're looking to buy low and sell high, right? So they may be more of a trader that trades, better in specific seasons in the market, more so than a day trader would as a aggressive investor. Sorry guys, I was tongue tied a little bit there. All right, so those are the differences between the three different types of snipers. All right, let's go ahead to the next slide. Now, do you have under 25,000 in your brokerage account? Now, if you do have under 25,000, what we typically recommend here is for you to have a cash account. Okay. Now, what a cash account is going to allow you to do is it's going to allow you to, first of all, have an unlimited amount of trades up to the amount of funds you have in your account. So if you have $200 in your trading account, you can only trade up to $200 worth of contracts for that day. Okay. Likewise for any other number that you have. That's what a cash account will allow you to do. Now, after you've initiated a trade, you would then have to wait until the following day for your funds to settle in your brokerage account. So you have to make note of that. Okay. You can't buy and sell something and then turn around and buy and sell something again with a cash account. You can do so with the margin account, but again, margin accounts also have its pros and cons as well. Okay. So you can have a cash account of any amount. Okay. And you can make an unlimited amount of trades. A lot of people usually ask, what does it mean to be a pattern day trader? What does it mean to incur the PDT rule or the good faith violation or different things like that? Usually those things are involved with having a margin account. Okay. So if you have a margin account and it's under 25,000, you can only make 3 trades through the period of 5 days. Okay. You can only make trades, 3 round trip trades, which means buy and sell. That would be 1, buy and sell 2, buy and sell 3. Okay. You only have 3 of those over the course of 5 days. So in order to get outside of that, we typically advise to use a cash account. All right, guys, let's go ahead and go to the next screen. Now we have some options terms. Okay. Options. What options is options gives the buyer the right or the choice to buy or sell a security at a specific strike price on a specific date, right? So they can buy and sell a contract before the expiration date, all right? So think of an options contract as more so a down payment on a house if we're talking about real estate, right? Let's just use an analogy of real estate. When we want to buy a house, we have the right to execute on that house based on our down payment, right? Our earnest money deposit, right? So it's literally the same thing with options. We have the right to 100 shares of whatever stock we have an options contract on. And then we are then given the right to be able to buy or sell that stock at a specific strike price based on the expiration, okay? Now, next thing, options contract. Options contract, again, one options contract equals 100 shares of a certain stock. So this is where we go into the idea of leveraging capital, okay? Next thing is a bid price. Very similar to a car auction, okay? The bid price is the lowest price at which a buyer is willing to pay for a contract at a specific time, okay? So when we talk about the bidding price for a specific contract, what we're saying is that the aggregate of all of the specific bidders on a specific contract, the lowest amount of that aggregate is what would be considered the bid price of that specific stock or options contract, okay? Likewise for ask. Ask is literally the opposite. The highest price at which a seller is willing to ask for a contract at a specific time, okay? Now, the next 2 things, buy, a call or put, okay? Calls or puts, okay? Now, before I go into the definition of both of them, it's very simple as far as being able to distinguish between the two, okay? When you call somebody, you call them up, right? So you pick up the phone and call up. So when we talk about calls, we're talking about a stock or an option going to the upside, okay? We're betting that the stock value will increase to a specific price within a specific period. That's what a call is. So you're calling up, okay? Now, put is literally the opposite. When we're talking about a put, we're talking about putting something down, right? Put down, right? You don't put something up, right? Well, some people say put up, but we're using put down, okay? When we want to put something down, that's what we're talking about. So we're betting on the downside. We're betting that a stock value would decrease to a certain to a certain price within a certain period, okay? So that's what it means to have a put, all right? Now, in the money, out the money. When you're in the money, it's when an options contract is trading at or near a contract strike price, okay? So if you're trying to choose between an in the money or an out of the money, which is the next one, which is literally the opposite, what you're saying is you want to buy a strike price that is currently either at, which would be in the money, okay, at or near the contract's price, or far away from it, which would be out of the money. So when you're talking about picking an options contract out of the money, it can literally be it could be out of the money in the right direction or out of the money in the wrong direction. Okay? Let's go to the next one. Now we have open interest, okay? Open interest is the record of the total number of open contracts in a particular commodity or options market on any given day. Now, an open interest on a contract is only going to update once a day, okay? So during the open of the market is when you're going to be presented the open interest. Now, what you're going to see with volume, okay, and that's the next one, trading volume, which is the number of contracts being traded each day, okay? When we're talking about volume, the volume is always going to be updated throughout the course of the trading day in real time, okay? Implied volatility is the market's forecast in the movement of a stock or contract price, okay? So let's say there's some specific news regarding a specific country. I'm sorry, not a country, a company. right, then there's some sort of implied move based on some news or an event that would potentially come up, let's say an earnings report or something like that, okay? Or some sort of press conference that the company may have scheduled, okay? Now we have market price or premium, which is the median or average price of an options contract determined by the current bid and ask of the underlying contract. Okay, so when we're talking about the market premium, we're basically saying the bidders are saying one thing, the askers are saying one thing, which is the buyers and sellers. Okay, so both sides are asking for a specific price. What is the happy medium? That's what the premium is. That's what the market price is. Okay. Strike price is a set price at which a derivative contract can be bought or sold if it is exercised. Okay, so we only have strike prices in stock options. Okay, so when we're talking about the strike price, what we're saying is if Apple is currently trading at 150 and you want to buy a contract with a strike price of 155, let's say you want to buy a call, what you're saying is that at a certain period of time, you are expecting Apple to reach from 150 to 155. Okay, that would be a call contract that you would be purchasing. Okay, now the 155 in which you're hoping the stock would go, that would be what we would call a strike price. Okay, that's what we would call a strike price. All right. Now, averaging down. What does it mean to average down? It means buying more of a stock when the price of the stock decreases to decrease the average cost per share that the buyer is currently holding. Okay. So when we're talking about averaging down, what we're saying is we potentially have purchased an options contract or a stock. Okay. And what has happened throughout the course of us holding that potential stock or options contract is that the value has decreased. What we would then do potentially, if you still see that options contract or that stock being of greater value than it currently is residing at that point in time, what you would do is you would do what we would call average down, which would simply be just to purchase more of what you had already purchased, but now at a cheaper price. Okay. Now, before I move on to the next thing, as a teacher, I guess I kind of have to give this disclaimer. It is not always a good thing to purchase an options contract or a stock at a less value than where you purchased it. Sometimes it's actually better for you to take your loss and reposition yourself into another stock or another options contract. Okay. It is not always a great idea to average down. However, what I do want to let you guys know is what exactly an average down is, right? How to average down. Okay. The next thing is the bid and ask spread, which is the measure of the distance between the bid and ask price. Okay, so it's the gap in which the buyers are willing to pay and the sellers are willing to take. Okay, so just think of it as tug of war. Okay, if one family's on one side and the other family's on this side, the distance between the two is what we would call the bid and ask spread. Okay, so let's say we're getting closer to the middle. That would mean the spread is tight. Okay, so when we say that the spread is tight, that means that both the bids, the buyers and the sellers are almost at agreements at what they want the price to be. Okay, but if they're far apart, that's when we say the spread is too wide. If the spread is too wide, we usually do not trade that options contract. Okay, a spread being wide is not a good thing. If buyers have one idea of what the value was and sellers have a completely different idea and it's way too farther than normal, I guess that's subjective, then we typically do not advise to trade that stock options contract. Okay. Then lastly here, liquidity is measuring how quickly a buyer seller can buy or sell a contract. So when we talk about liquidity, we usually like liquidity. Okay, we want liquidity. Liquidity allows us to be able to buy or sell something usually at any time we want to. Okay, if there is no liquidity, we will not be able to buy or sell anything, right? So one of the worst things you would want to be in is a situation where you're selling or you're trying to sell a options contract in the stock market and there's no liquidity. What happens? If there's no liquidity, if there's no one there to purchase your contracts, then there's no way for you to take profit, even if you are in profit. And if you're in a loss, there's no way for you to even take the loss that you want to take. So let's say you're down $500 on a trade, but there's no liquidity. If there's no liquidity and you have nobody to sell those options contracts to, then you would potentially lose that entire position amount at that time. So it's very important for us to be able to see liquidity and trade only when there is liquidity in the stock market. All right, guys. Now we're going to briefly go over the Greeks. The two Greeks that we're going to go over is delta and theta. Now, what delta does rather is it measures how much an options price is expected to change per $1 in the price of liquidity. Okay, so there's different examples as to what or how delta changes throughout the course of the stock market. And then inversely would be theta. Okay, theta is essentially time decay. So as the time begins to lessen within the stock market, right? Because the stock market is open from 9:30 a.m. Eastern to 4 p.m. Eastern. So if we have a options contract that expires on the same day, a 0-day expiration, then theta is time decay. So as time continues to progress, and let's say your options contract is going the opposite way, your options contract is going to increasingly become less valuable than normal. Okay. So that's the difference between delta and theta. Now, in the stock market or even in options in general, what we have usually is we have catalyst, okay? And what a catalyst is usually there's some sort of news report, maybe even considering the federal government and some of the talks that they have. The Fed chair currently, who is Jerome Powell, if he's up on the stand and he's discussing something, then there is usually a response in the stock market, typically within 30 minutes or so of, and that could be before he gets up there or after he gets up there or whatever the news is, right? Let's say that there's a company that acquires another huge company, okay? That also is considered a catalyst in the stock market. We always want to be aware of these catalysts. And here below, we have a couple examples of these catalysts. We have company earnings. We have product launches, okay? Political news, that's what I just referred to, okay? Investment and market sentiment, upgrades and downgrades, management transitions. So there's so many different catalysts that can occur in the stock market. You want to be very aware of these catalysts so that you can position yourself correctly. And when I say position yourself correctly, that doesn't mean to guess a specific direction based on the news. What that means is potentially not being a participant while the market is too volatile and waiting for things to settle or waiting for the news report to settle so that you would be able to take advantage of whichever direction a stock or option is going at that point of time. Okay, guys. Next, we have our candle anatomy. Okay. So we're going to go over all the things we need to learn about a candle when we see them. Because here's the deal. Candles have different stories. Okay. There's a different story for every candle that you see in the market. All right. So we have two examples of candles that we're looking at here. We have what would be a bullish and bearish. Okay. So where you see me pointed here would be the close of a candle. Okay. So when we talk about closing on a candle, what we're saying is let's say this is a 1 minute candle. This is all the price action, all the buying and selling that occurred within this 1 minute. Okay. Or if it's 5 minutes. Okay. So if let's say at this level right here that I'm slashing through would be at 100. If we go up here, let's say this was 101. The high was 102 on this candle. The open was 99. Okay. The low was 98. Okay. Let's say those are our numbers. So what it would have looked like is we would have opened up at 99. Okay. We would have went down to 98 at some point within that 1 minute. We would have went as high as 92 in this 1 minute, and then we would have closed at 91. Okay, so if we close at this level, then that's how this candle forms the way it looks right here. And then the very next candle for the next interval, which would be either 1 minute, 5 minute, 15, 30, whichever interval you want, the next one would potentially open near where the last one closed. So it would either open up somewhere here or somewhere here. Okay, this next candle, which we see is a bearish candle, it opened here, right where close was. Okay. It potentially went as high as what we call this was 92, okay, or 102, sorry, and then it went as low as 99 or 98 rather, and then ended up closing at 99. Okay, so if we still use those same numbers from the bullish candle and the bearish candle, right? The middle being 100. Okay, the close of the bullish candle was 101. The open of the bearish candle was also 101. Both highs were 102. The open of the bullish candle was 99. The close of the bullish candle, the low of the bullish candle was 98. Both lows were 98. And then the close here was also 99. Okay. So that's how a bearish candle would look. And that's why it would be red. Okay. So what it's showing is potentially it opened at one area and closed lower than it opened. That would be what we would consider a bearish candle. What we would consider a bullish candle is literally the exact opposite, where we open at one level and we close above the level that we opened at. Okay. All right. Let's go ahead to the next screen here. All right, we got a mentality check, okay? Anybody can get lucky. Always remember, success is a marathon. Successful investing takes time, discipline, and patience. That's from one of the best investors out there, Warren Buffett, right after all of our Option Sniper University students, okay? So Warren Buffett is one of the best investors, but he is not better than our students, okay? Next, we have both long versus short. And this is essentially the exact same as our last slide here as far as bullish and bearish, right? Because long would be considered bullish and then short would be considered bearish, okay? So we're kind of going basically into the differences between what these candles would look like. The larger candlestick obviously would have more price action. The smaller candlesticks would have little price action. Okay, so if you see a small candlestick like this, that means it's still fluttering between a short amount or tight amount of price action. Okay, let's go ahead to the next screen. Now we have wicks. Okay, so what a wick would be is where we would see price rejection. Okay, so if we have a long wick, that typically means that there are buyers pushing this stock or this options contract to the upside, and then literally the inverse for the wick for bearish. Okay, so if we hit it, let's say we hit a support level up here, you would, or a resistance level rather, you would start to see sellers take the stock to the downside, which would then form a long wick like this. Okay, let's go to the next. Now we have Doji. Doji is very simple. Doji usually means that we are undecided. We don't know where we're going. We don't know if we want to go upwards or downwards based on that specific interval. Okay. We normally see dojis on larger time frames, but there are some times where we have smaller time frame dojis that usually can form within pre-market. So that's something to watch for. But usually a doji usually signifies that we're not sure who wants to take the move. As we could see here, our notes say that each party is waiting for the other to move. So we're not too sure. What this means is just to be patient, okay? Wait on the next candle to open up so that we could figure out which way we would be headed. Time frame logic. Not only are candlesticks important, but the time frame they are found in is important as well. We need to make sure that we're using multiple time frame analysis to confirm our exit and entry. Okay, because not only one candlestick will be able to tell the full story. And I can tell you guys from full experience, okay, you want to definitely make sure that you're using each and every time frame in order for you to be able to make the right decision in the stock market. What I like to use the 5-minute chart for scalping on a day-to-day basis. I use the 5-minute chart specifically because I can see the setups and patterns a lot more clearly than some of the lower intervals. A lot of traders use the 1-minute chart. I'm allergic to the 1-minute chart. I cannot use the 1-minute chart. It's not a good chart for me. I use the 5-minute chart. It allows me to be patient in my ability to enter and exit trades effectively. Okay, guys, the other time frames I like to use is the 15-minute time frame, typically during a pre-market session. Okay, so before the market opens at 9:30 a.m., all the time before that is when I use the 15-minute chart. It allows me to do some pre-market analysis and show me the different outcomes that can potentially happen based on specific price levels for a ticker. Okay, guys? So we want to make sure that we use these time frames. We have our lower time frame analysis, which essentially would be zooming in on candlesticks. Okay, so when we're using the lower time frame, we're essentially kind of narrowing in and getting a closer look into what is potentially happening, where we're trending at a specific point in time. Okay, now when we have the higher time frames, it's simply just an aerial view, right? So instead of being lower and closer to the action, when we are in a higher time frame, we're looking at more historical data. What has happened within the last few weeks, potentially the last few months. Okay, guys, that's what we want to use when we're looking at the higher time frames. Okay. Trend lines. Trend lines are your best friend. Okay. If you see specific stocks following what would potentially be an invisible line, that line is essentially a trend. Okay. So what we call that is a trend line. Okay. We want to make sure that we identify these trend lines when we're in the stock market, because these essentially gives us a an advantage over traders that do not know or use trend lines. Okay, trend lines actually gives us some sort of indication on how we can predict where a stock or an option would move based on the specific time frame. Okay, guys, so we want to make sure that we have an understanding of how to use these trend lines. Okay, then we have support and resistance. All right, so support would be places where multiple candlesticks have touched a certain price but not broken under. So think of support as, you're essentially supporting something so it doesn't go further down. Okay. If you have a support system, that means that this support system is people that do not allow you to get too low. Okay. So they keep you up. That's what a support is. That's what support is in the stock market. Okay. So if a ticker or a stock is deciding not to go below for whatever reason, we would consider that a support level. Okay. And this is where, and we identify support levels with multiple confirmation. So if it just bounces off of one level, that's not enough for us to consider that as support. Okay. What we consider support typically is if there are multiple candlesticks that happen over a specific period of time at the same point. Okay. And literally the opposite is what we would call resistance. Okay. Resistance would be a ceiling. Okay. Think of resistance as a ceiling where the stock can literally not go up past that price level for whatever reason. Okay. That's the difference between support and resistance. Now we have double tops and we have triple tops. Okay. Now, usually with double tops and triple tops, or double tops and or double bottoms and triple bottoms, what happens is it's what I would consider agitation. Okay. So it's like, let's look at bottom 1 and 2 here at this top screen. Okay. Bottom 1 is like, fool me once. Okay. Bottom 2 is like, fool me once, shame on you. Okay. Fool me twice, shame on me. Okay. So it's almost like we've learned our lesson. We get to one point where we're like, okay, we reach this level, buyers step in, and then sellers come back. But then if we reach the same level again, buyers are coming back and saying, wait, we're still here. We're not letting you get past this level. So then they push the stock or the ETF back up to the upside. Okay. So that would be what we would consider a double bottom. Okay. It's what I consider, like I said, agitation or price agitation. Okay. We're literally watching as buyers are being very aggressive based on that level, because they don't want to see us go further than where it was. Okay, that would be a double bottom, and literally the complete opposite would be the double top. Okay, so let's say it comes. We have two touches here at the resistance level. Okay, if we have 2 touches, usually, or 3, usually there is downside momentum. So that essentially means that we cannot get higher than that level. Okay. So it's very pivotal for us to watch the levels of support and resistance, because if we do get breaks, there are typically areas of entry for us to start making money either on the upside or the downside based on what the setup is. Okay. Double would be 2 touches. Triple would just be 3 touches. Okay. So this would be triple down here. Okay. 1, 2, 3. We have 3 touches to the bottom. So we start moving to the upside. Okay. All right. Next, we have head and shoulders. Okay. Head and shoulders is when we have the first move breaking a level. We come back to the same level, and then the second move breaks even further than the first move. Okay, so that's what would look like a head. Okay, so we have the one shoulder, we have the head, then we have the second shoulder. Okay, usually head and shoulders either reverse the regular head and shoulders or the reverse head and shoulders. Usually I like to see it as a triple top or a triple bottom because that's literally what it is. Okay, if we're looking at a head and then a shoulder, the shoulder is one top, the head is another top, then the next shoulder is another top, and then we start going to the downside. Okay, so that would be what a head and shoulders is. It would be a bearish trend. Now a reverse head and shoulders is literally just the head and shoulders reverse. Okay, so it would be it would be bullish at that point where we have a shoulder, which would be the first bottom. Then we have the head, which would be the second bottom, and then we have the next shoulder, which would be the third bottom. So that would essentially form a triple bottom, which would then bring bullish momentum. Okay. Next, we have bull flag and bear flag. I like to think of bull flags and bear flags as consolidation. We have it absolutely right. When we're consolidating, this is our price action essentially becoming the buyers and sellers deciding to then agree on the price. Okay. Agree on, sorry, I had a brain fart there. We then decide to agree on the price based on whatever price level that we're currently out. And so once we do have that consolidation, there's usually a breakout that could either be to the upside or to the downside. Okay. Again, the complete opposite is the bear flag. The bear flag is when we already have some consolidation. We come to the downside. We would potentially form a bear flag where the buyers and sellers are then continuing to consolidate, and then we would then have a breakout to the downside. Okay. Next, we have the falling wedge and the rising wedge, usually kind of giving the same formation as a bull flag and bear flag. So you definitely want to make sure that you have the understanding of that. But usually with the falling wedge or the rising wedge, there's a channel that is formed. Okay. And what I mean by a channel is that we have two trend lines that are literally following each other and they look kind of symmetrical. Okay. That's what would be called a channel. Okay. So when we have that sort of channel, and we have price action going from up and down, that's usually what we would consider either a falling wedge or a rising wedge. Okay. All right. Then we have an ascending triangle and descending triangle. I like to think of this as essentially the wedges and the triangle put together essentially. So it's funny how it's the third thing here. We want to make sure that we have the understanding that an ascending triangle means that we're going to be going to the upside, descending, which means we're going to the downside. That's usually where support continues to move upwards while the resistance stays the same. Okay, so if we have an ascending triangle, as the support continues to increase, that means that we have buyers stepping in at every touch of this trend line while the resistance stays the same. This would mean buyers would essentially continue to take this to the upside. Okay, and the exact opposite would be true for the descending triangle. Okay. All right. So one thing we need to make sure that we're aware of as far as patterns and setups and things like that is that they are great indicators, but they are not the same as far as the reaction of these setups and these patterns. Okay. So we need to make sure that we're using wisdom pertaining to these patterns. If we see a double bottom that is not, or we see it as something that would look like a double bottom, but it's not fully forming that second bottom, then we need to simply just say this is not a double bottom and move forward. Okay. Now, even if we do have a double bottom and then it starts to break to the downside, even after a double bottom, then we still have to have the understanding that at the end of the day, these patterns are great indicators, but they themselves are not what allows us to be or to have 100% success in the stock market. Okay. Everything, there's always changes that occur in the stock market, but however, there is some predictability as far as human behavior. So there are times that these patterns that are going to work. Okay. We would say potentially about 80%, 85% of the time when you see these patterns, they do work. Okay. But if they don't work, it's not because you're not a good trader. It's not because you didn't do your work. It's simply because there may be news that was released that completely changed the pattern. Okay. There could have been a huge buyer that just decided to invest at that point in time. There's literally any reason that things can change from pattern to pattern. All right, guys. So definitely make sure that you compound your confidence when it comes to that. All right. Now, with that being said, we want to make sure that you guys are as equipped as possible when it comes to options trading. Obviously, you just watched this video for about 30 minutes or so, and you have much more knowledge than you did when you first started watching this video. Now, how much more knowledge do you think we would have to offer over the course of 5 days during our 5-figure trading challenge? That's right. I want to go ahead and introduce you and invite you to the 5-figure trading challenge, where we host you guys live for 5 days over Zoom, Monday through Friday from 6 to 7 p.m. Eastern. Every single day of those 5 days, we're going to be giving you guys everything you guys need to know to become a hyper profitable trader. On day 1, we go over the mindset of a trader. We go over the discipline on day 2. We go over emotions on day 3. We go over tactics on day 4. And then we go over the profit-taking strategies of a hyper profitable trader on day 5. You guys are going to leave feeling like you are about to explode. Okay. And we guarantee that. So I want you to go ahead and visit 5figuretradingchallenge.com. Go ahead and purchase a ticket. Listen, if you want to be having another passive, or I would really say active income in your life to be able to invest in other opportunities, you need to go ahead and do so. I would say go ahead and get the VIP ticket, specifically because you guys can ask us questions at an additional period during those 5 days. Okay. So after the first hour of our meeting, we would then meet for another 30 minutes for our VIP folks. Okay. So you guys can go ahead to 5figuretradingchallenge.com, go ahead and purchase your ticket, and we will see you soon. We can always be in contact on our socials. Okay. So go ahead and follow us at Option Snipers University. Go ahead and subscribe to our YouTube channel, Option Snipers University. Go ahead to our website as well, optionsnipersuniversity.com. And, leave some feedback. Leave us some comments. If there's things you want to learn about, some content that you want to learn, go ahead and post it on our YouTube channel in our comments. Don't forget to like, subscribe, share, all those good YouTube-y things. And I think that's everything. So we're going to go ahead and wrap it up. Thanks for joining me today, and I will see you soon. Peace.